Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
You know, I'm just realizing I have a Christmas theme song that I have not added to my board to be able to play. And considering this is the last full week until second week of January, I probably should get that loaded up and ready to go. Not much time left, I will say. Not much time. But welcome, everyone, to the final. This is the final full work week of 2025 because, next week's Christmas. And then after that, we got, of course, New Year's. And then it's 2026, baby. So this is the last full work week of 2025. And it feels good. It feels good. But welcome, everyone, to Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina. This is, of course, the Wilmington Mortgage Podcast, where we break down the top stories impacting mortgage rates in Wilmington, basically explaining why rates are doing what they're doing. And since it is Sunday night, we're getting bond yield, bond futures. And we're seeing a little bit of decline in yield, a little bit decline. But last week, bond yields actually rose. And it kind of makes sense, in all honesty. I based on what we saw on Wednesday, what we heard on Wednesday, I was not surprised that yields were up for the week. The 10-year was up about 5 basis points to 4.18%. That is the highest level since the end of September. And Mortgage News Daily also had the 30-year fixed rate mortgage, their index. They had the 30-year fixed at 6.32%. That was also up 5 basis points for the week. So why were rates up? Well, it all, of course, stems from what happened on Wednesday with the Fed meeting, not only the Fed decision, but then, of course, the press conference and then some of the comments from Fed governors later. And I'll be honest, when the report first came out, I looked at it and, looked at the projections. I, watched the press conference and I said, this is not an environment for a rate cut or a rate cut that's going to be happening. So we've gotten 3 rate cuts in a row. From my perspective, it was like the rate cut cycle is over. And the market's interpreted a little bit differently. I don't know if it was like optimism about the economy and then maybe some optimism about inflation that, Powell had said, tariffs weren't having as big as an impact as many had thought, but we were expecting a little bit more growth in the economy. And so, maybe a little bit, better inflation data, strength in the economy that could lead to a possible rate cut. And not because they're trying to stimulate the economy, but just kind of moving it from a higher level of neutral to more middle level of neutral. I thought maybe that's what they were interpreting, but I think what happened is the markets kind of started interpreting the data as I did, which is a good thing. I'm glad to see when markets start agreeing with what I was thinking. And we saw that from Jonathan Levin over at Bloomberg. He wrote in his newsletter last week that, quote, "It is looking extremely likely that Jerome Powell has overseen his last interest rate reduction as chair of the Federal Reserve." He added that in his perspective, the bar is now significantly higher for the Fed to carry out further reductions. And that was sort of the argument that Powell made. Like I said, they said that they're now kind of at that neutral level. So once again, it was not about them cutting rates to stimulate the economy. It was more about moving out of a maybe overly restrictive policy area and getting it into a neutral area. So it's neither restricting nor stimulating the economy. But like I said, we're on that sort of upper end was the argument that Powell was making. And so Levin's saying, it's not likely that we're going to be getting a rate cut until we have a new Fed chair. And that's not going to happen until May. And then that meeting, I think, is not going to be until June. I think there's a June meeting. So let's say best case scenario, Levin's arguing a June rate cut. So that means we're 6 months away from a possible rate cut. And that skepticism was sort of reinforced on Friday when Chicago Fed President Austin Goolsbee explained his dissent on CNBC. He, of course, was one of the votes that voted against the 25 basis point cut. Him and the Kansas City Fed President Jeffrey Schmidt voted against the 25 basis point cut. There was a third dissenter, Stephen Mirren, but of course, as he did the last two cuts, he was actually calling for a 50 basis point cut. So he was not on technically the same side as Goolsbee. Goolsbee told CNBC, quote, he was uncomfortable front-loading too many rate cuts and assuming that what we've seen, inflation will be transitory. And so he's arguing that he's not convinced that inflation is in the sort of transitory state, that it's naturally going to fall back to that 2% target. And so he didn't want to front load too many rate cuts. And that was, like I said, that's sort of probably the argument that Schmidt would make as well. But here's what's interesting. So Jerome Powell, of course, has been criticized pretty heavily by President Donald Trump and others in his administration. Howard Lutnick, I think, also was critical of the 25 basis points, saying it should have been 50. Trump supporters have been very critical of Jerome Powell. But here's what's interesting. So Nick Timiraos over at the Wall Street Journal, he wrote, Jerome Powell pushed through a rate cut Wednesday over the broadest reservations of his nearly 8-year tenure. Timiraos noted that 4 additional Fed officials quietly signaled opposition by penciling in a higher policy rate for 2025 in the Fed's projections, an implicit message that they would not have cut at all. And so here's what's interesting. So like I said, Powell's been criticized by, the president, people's administration, supporters of the president. But it's pretty clear. I mean, it's very evident that Jerome Powell was able to get the votes necessary to approve this third rate cut. That had he not pushed, had he not gotten those members on board, I don't know if there would have been the votes for it. I mean, that's pretty evident from what we're seeing with the projections. And so it's kind of funny that even after he did that, he still got criticized for not cutting enough. When it looks very evident that he was the reason. So a lot of people think he's the reason why we're not seeing bigger cuts. It turns out he's actually the reason why we had to cut it all. Otherwise, there probably would not have been one. He was able to get those votes, secure those votes for that rate cut. And it could be kind of a rocky end to 2025 because we have a very big week ahead of us. This could be the first time in history. I don't know. I didn't look this up. I'm not going to lie. But because the only reason this is happening is because of the government shutdown. So what's happening is we're getting 2 non-farm payroll reports, 2 jobs reports this week, and we're getting an inflation report. And I don't know if we've ever had a week where we had a jobs report and an inflation report. I'm sure it's happened. But it does feel very sort of historic in that we're getting 2 jobs reports and an inflation report. Now, the inflation report is from October. The jobs reports are from October and November. And here's the problem. So one of the main reasons why the Fed officials do not want to cut rates is because they are still concerned about inflation, as Goolsbee said. And according to the estimates, the consumer price growth is projected to rise. Core inflation, and I think actually the top line number, both, are supposed to rise to 3.2%. That's a problem. That is 60% above the Fed's target of 2%. That would be, for core inflation, the highest level since January. And for the top line number, all items, highest level since May 24. And then on top of it, we're supposed to be getting some not great labor market data, but it's still supposed to be positive. And so, yeah, I mean, someone put a gun to my head and said, what do you think rates are going to do this week? I would say rates are probably going to keep rising. Not crazy amount, but it does not look like it's going to be a good week for data. And this, of course, following a Fed meeting in which pretty much smarter people than I are interpreting this as we are not going to get a rate cut while Powell is still Fed chair. Not because of him, but because he was lucky to get this one. So he was lucky, like I said, if Trump was looking for a rate cut, he was lucky that Powell was able to get this one. But any following cut with this data that we're expected to get this week, if it's true, it's almost 0% chance that we're going to see anything happen unless those inflation numbers start to fall. So like I said, it is a big week. 2 jobs reports, a inflation report. We're also getting a lot of central bank decisions following, of course, the Fed decision last week. So on Tuesday, we're going to get a pair of employment reports, starting with the delayed October jobs report, which is expected to show the economy creating 55,000 jobs in October. Then in November, we're expected to see a report that's supposed to show only 35,000 jobs created. So obviously those numbers are way down from the averaging that we've had over the last couple of years, even just the last year. Those are not good numbers. Now, the replacement rate is around 120,000 jobs. Now that number's probably fallen because of changes to immigration. So let's just say 90,000. That's still, we're looking at almost half, a little bit above half, and then well below half. But they're still positive. So you could argue with the replacement rate that technically the real number is negative. The actual data is still showing job growth. We're not seeing jobs being cut yet. We're still seeing job growth. And so if we get that job growth with the CPI report, which is supposed to show inflation rising to 3.2%, which once again, the highest level since May 2024 and core highest level since January, that is a recipe for higher rates. If that is the case, we're still seeing job creation with rising inflation. That is a recipe for, once again, nothing crazy. I'm not talking like we're going to be back at 7% for the 30-year, but that definitely is a recipe for slightly higher rates. Besides that, we still got a lot more data going on. Home builder confidence, we're going to be getting that on Monday. That's supposed to rise slightly. Retail sales expected to be somewhat, not great. 0.2% rise in October. And then Wednesday, we're getting both UK and Euro inflation data. And then Thursday's the big day. Bank of England, they're expected to drop rates to 3.75%, while the European Central Bank is expected to hold rates at 2.15%. And then the Bank of Japan, which is having some issues with inflation, they're expected to raise rates to 75 basis points, 0.75%. So we're going to get 3 central bank decisions from major areas, Japan, Euro area, UK, all different. Cuts, hold, increase. I don't know if this is like a week of firsts. That's all. I don't know if I've ever seen that before, with 3 central banks all making different decisions about that. It just shows you how crazy and chaotic it is on the global scale. Existing home sales expected to slow to 3.9 million. That is coming out on Friday. Real quick before we go, Wall Street Journal reporting that President Trump, we originally thought was going to be Kevin Hassett, the next Fed chair. He's still in the running, but also Kevin Warsh is also apparently still in the running. So it's the battle of the Kevins. Once again, we're getting that argument. We've been hearing that for a while, but it looks like it's, once again, the Kevins battling it out. So that's in the Wall Street Journal by, not surprisingly, Nick Timmeros. You guys enjoy. Hope you enjoyed your weekend. Get ready for the work week, and we'll be back here Monday afternoon for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.